Dun, 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 dun. Dun, 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 dun. What's up? Seems like a good spot at the end. Hello and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. Today we're going to be talking about Bitcoin miners halting sales on Bitcoin as they're expecting the price to go up. This is something that I've been thinking about quite a bit as we roll into the traditional halving cycle of the second pump up, and that should go through October. We'll talk about it more, of course. We're also going to be talking about the alt season. Is it coming? I don't know if alts are actually doing anything this time around. I'd like to hear what you guys think about it as well. We're also going to be talking about some public miner shares and how they're doing in the stock market, of course. And the two big things that I'm kind of curious about, there's a proposal from DigiByte and Vertcoin to basically swap Vertcoin to multi-algo that DigiByte utilizes and then add in some merged mining. So I guess potentially you'd be earning DigiByte and Vertcoin. Kind of odd because obviously Vert hash is a big deal. I'll get into it more, obviously, as we get into it. And we'll be talking about the other big one that I thought was really interesting. We'll be watching a video from Rabid because, dude, I tried to do some research on this, but I guess you can mine Monero on Qubic now. And it's extremely confusing. I got to dig through it some more. I'm going to get an update from Rabid's video, link that over to you guys, and then kind of dig into it and see what's going on. Other than that, this week, really, obviously, the price of Bitcoin's recovered since I streamed last a little bit more. I think the average price for Bitcoin in the US to be profitable at the average rate is going to be like 107,000. So we're really looking to get above that $107,000 mark with the increase in difficulty on the network, obviously. Still putting pressure on the last gen ASIC miners from Bitmain, like the S19s, obviously like the M50s, M60s from WhatsMiner. All those are struggling. GPU mining is looking a little bit better with both KY as well as Qubic kind of pumping up there, and Qubic being focused primarily beneficially on the GPU side over the CPU side as of late. And that's going to be an interesting one to take a look at. I want to say thanks everybody for stopping in. Crackling, good to see you here. Design of Modern Life, good to see you. Spec Mining, AFCO, Rizzo, Richard, and Ivan, as well as Squirrel Master. Good to see you guys. Richard did say, do you have a video on how to solo mine Bitcoin to my own node? I actually probably, but it might be out of date at this point. You could Google around for it. I could try to find it for you. I know I've done videos on how to build, Bitcoin nodes. Now there's a couple more steps that you have to add in there, I think, to mine to it, but you can build your own pretty simply these days, and you can enable that. Maybe that's a good idea for a video. I am kind of getting back into the swing of things with health. I should be starting work back here next week, getting off of that short-term disability. I finished the surgery on my back last Thursday, a little bit down from that still. So we'll see how the stream goes today. And then after the stream, if you guys want to stick around, one of my favorite games here just launched. We're going to be playing it over here, but the Doom Dark Ages game just came out. So I'll be streaming that over on Twitch after this. So make sure you're following over on twitch.tv/blindrun. I have been playing the Elder Scrolls remake, Oblivion, as well, just because, well, I've been laid up and it's a great game to play while you're laid up. And so that's been pretty fun if you want to talk about that after the crypto portions. And Scrollmaster does note that the alts aren't doing much of anything compared to previous bull runs. And yeah, that's most noted by, of course, Ethereum not hitting its all-time high. previous all-time high. This is just something that's been happening, nonstop. There is an indicator, according to Cointelegraph, that the altcoin season might be coming back. I'm not really seeing it, because even like things like Caspa have not, like, so if we were going to say there's no altcoin season for previous cycle coins, maybe we would have one for new cycle coins, right? But Caspa, as we've seen with the recent pump up in the altcoin market, like just as an example, Caspa hasn't even hit its previous all-time high. I think Solana, I think the closest that I've seen overall was like Monero. That's not a new cycle coin though, but we did see Monero pump up almost to its previous all-time high. And that's despite being on any centralized exchanges or being off of a lot of centralized exchanges. So it's pretty interesting overall. But let's go ahead and get into the first topic. As always, talking about mining. Bitcoin miners halt sales as Bitcoin gains 20% since hash ribbon buy signal. So this article goes over Bitcoin accumulation by miners is back as network participants swap selling for holding at $75,000 lows. Data from on-chain analytics firm Glassnode shows that miners are now actively adding to their Bitcoin reserves. Bitcoin hitting multi-month lows in April sparked a sea change in miner behavior, with a lengthy selling streak reversing into significant accumulation. Glassnode shows that shortly after Bitcoin bottomed just below 75,000, the balance in miner wallets itself found a floor, only to then start increasing along with the price. Miner wallets held 1,794,622 Bitcoin on April 12th, while as of May 13th, they had reached 1,797,330 Bitcoin, an increase of 2,708 Bitcoin or 0.15%. While minimal in terms of total miner holdings, the turnaround is conspicuous as it follows a run of selling that initially gained momentum in late 2023. This in turn has led to optimism over the Bitcoin price trajectory. Extremely bullish for Bitcoin is what a trader and investor named Mr. Crypto summarized in a reaction on X, referencing similar data from on-chain analytics platform CryptoQuant. Earlier, Cointelegraph reported on decreasing miner sell-side pressure, helping contribute to price trend, with institutional buy volumes dwarfing the amount of mined Bitcoin per day. A classic metric covering miner behavior continues to display classic performance since its latest buy signal. Hash ribbons created by quantitative Bitcoin and digital asset fund Caprioli Investments uses two moving averages of hash rate to delineate periods of capitulation among miners. Since offering its last market entry tip in late March, Bitcoin USD has gained around 20%. Quote, "The hash ribbons are still flashing a buy signal here," Mr. Crypto commented in a post on the phenomenon this week, predicting Bitcoin price to go much higher in May. So, here's the interesting part. As a whole, I would say it's clear that we're still following that traditional halving cycle. We're seeing suppressed prices. I talked about this last week. I think, the all-time high range this cycle is nowhere near what the original projections would be, around that $200,000 mark. It is much closer to that $120,000 to $150,000 mark. And we are running out of time for the traditional halving cycle impact. But there is still evidence, as seen in this article and the accumulation from miners, that miners still influence the price of Bitcoin, albeit not by as much as they have in the past, due to the fact that, of course, there's waning block rewards, and that will only be less and less impactful, the halving that is, as we move forward through this new innovation of cryptocurrency and all of that. So I think when we move into the next cycle, we'll probably see even less impact on price. Of course, we could say macroeconomic factors are impacting this as well. I'm not so sure. I think maybe for the low end of side of things, but not for the top end side of things. And that's because, like I said, as there's less block reward for Bitcoin for miners, there will be less of an influence of mining on the price of Bitcoin, which will be a lessened euphoric spark, right? So the euphoric spark comes from the depreciation of the supply, the release of supply into the market, right? And so that as less and less of that is impactful and the price of Bitcoin stabilizes based off of what's in circulation, then that's how that would play out. Similar to, obviously, on a much faster timeline, something like Caspa, where it's clear that the holders of the cryptocurrency itself influence the price a lot more than the actual miners themselves. And this is just the nature of the beast when you're talking about the supply cut, right? The reward of the halving, or the reward being cut in half from just the nature of the way mining works in most cryptocurrencies. I think that's why we're not seeing as much of an impact more than the macroeconomic factors. I think the macroeconomic factors obviously are impacting miners directly from the idea that, like, we aren't seeing US side miners stay as efficient as, you know, abroad miners. Luckily, from the USA perspective, like we've talked about in the past, it really comes down to energy cost over cost of miners. It's just a matter of getting the miners stateside that has potentially affected it as of right now. So that's kind of how I look at it right now. And please don't spam in chat, by the way. So that'd be good. There we go. And yeah, there we go. Mick says his favorite miners in this order. He's favoring Marathon, BitDeer, and Wolf. I think we can talk about that in a second. I thought I logged in here. There we go. Yeah. Anyways, let's talk about the alt season, because obviously it's a lot easier to look at the halving of Bitcoin, look at the decreased effect of miners on the price of Bitcoin. And in this particular case, I think altcoins are a lot more difficult to predict right now. We've talked about this in the past. Number one reason being most of the inflows are coming from Phantom Wallet into the cryptocurrency space. Phantom Wallet is known for the meme tokens. A lot of the liquidity from the public is going straight into meme tokens, as opposed to previous cycles. It would go into a centralized exchange, and the listing on the exchange was the most impactful indicator as to rise in price of different cryptocurrencies or alternative layer one. And the distinction here that's important for people that are not in the know is that a layer one project will have its own blockchain completely separated from all the other blockchains in most cases. Of course, there's different things that we could talk about, like parallel chains, etc., if we're going to go into like Komodo or a bunch of other stuff. But when we're talking about tokens, that's going to be on a layer on top of an individual cryptocurrency. Ethereum, obviously, being the layer one most famous for all of the all of the tokens built on top of it. And so the onboarding process goes get in via the layer one directly and then participate within that ecosystem. This is why previous cycles, of course, Ethereum was extremely profitable for GPU mining, as well as performed really well, is because you had kind of a three-step process, right? You come in through a centralized exchange, you put your money into Ethereum, and then you'd go into the Ethereum ecosystem. You participate within the NFTs and the tokens on that system, the DeFi. And that would obviously bring up the fees on the network, making mining more profitable, as well as just pushing the price of Ethereum up because of the demand for that particular blockchain. What Phantom Wallet has done with Solana is streamline that process to where a lot of new users being onboarded into crypto are going directly into the layer 2 token solution on Solana within that ecosystem and spending all of that liquidity directly in there as opposed to going through a centralized exchange. And if you talk to like any normies that have like Coinbase or crypto.com installed on their phone, a lot of times they're leaving a lot of their liquidity within that centralized exchange, and they're trading within that centralized exchange to then obviously hope that they see number go up, and they will see whatever layer 1 options are in there and purchase those directly. Now, the centralized exchanges this time, as opposed to previous cycles, also, which is an important note, have begun essentially seeing what's popular in the token ecosystems, the layer 2 ecosystems, and then implementing those into their centralized exchanges, whether that be Trump token, Melania token, Fartcoin, whatever it may be. Then they're listing those, as opposed to previously what a lot of centralized exchanges would do is they would have their kind of rules and regulations for listing a particular layer 1 project. They would focus on those layer 1 projects, whether that be, Ethereum, Ravencoin, Ergo, whatever it might be, and then put those into the centralized exchanges. And when those new listings hit, there was an impact on the price, but a lot of that's gone away. Like I said, you can see the shift in the cryptocurrency market very clearly now over to this direct into the layer 2 ecosystem through Solana. The centralized exchanges are influenced by the DeFi and not the other way around, right? And I think that's important to take a look at when you are determining, obviously, what's going to happen in the altcoin market, especially as it pertains to the GPU mining space and the mining space as a whole, whether it's GPUs, CPUs, ASICs, and so on. Now, they do say on Cointelegraph that an alt season is coming, 40% daily gains to become the new normal, says an analyst. I don't know if I agree with this, but altcoin markets are flashing early signs of a breakout, with several analysts calling for a potential surge over the next few months. Crypto commentator Mr. Crypto, which apparently they are huge fans of Mr. Crypto over here at Cointelegraph, predicts the next 3 to 6 months could be life-changing, suggesting daily gains of up to 40% may soon become the norm. In May 11th post on X, he pointed to a chart from blockchaincenter.net that shows whether the crypto market favors Bitcoin or altcoins. When the index is below 25, it's considered Bitcoin season, meaning Bitcoin is outperforming most altcoins. And when it's above 75, it's altcoin season, meaning altcoins doing better than Bitcoin. Currently, the chart shows a breakout from a downtrend just below the 29 mark, suggesting a possible shift away from the Bitcoin dominance. This breakout hints that altcoins may be starting to gain momentum, potentially entering a period where they outperform Bitcoin. And then it goes on to say that others see the rally, but warn it's not the same as previous cycles. Analyst 2 Lambros agrees that the altcoin season may have arrived, but says the dynamics have changed. Quote, people want to bid but lack belief in any strong narrative, end quote, he wrote on X. He noted that unlike 2021, there's no sign of retail investors entering the market. Traders are rotating capital faster with little incentive to hold long-term positions. Technical trader Mustache offered a more optimistic view. He shared a chart showing repeating altcoin accumulation phases followed by explosive growth. According to him, the current structure mirrors those of 2016 and 2020, saying, quote, altcoin season 2025 has officially begun. However, skeptics remain, and commentator Wrecked Fencer pointed out that most altcoins have been down 90% since December. A modest 10% bounce this week sparked exaggerated optimism, prompting him to mock the rally. This is the altcoin season we've all been waiting for, he joked. And then he has this big downward trend. Of course, if we looked at CoinMarketCap, this is the 7-day, and this is my list of, proof of work cryptocurrencies. And I think, like, obviously we can click in on any single one of these. I think one that's been around, let's do Dogecoin, right? Let's do all. And you can see here, this is 2021, the last cycle going up to, 60 cents or somewhere around there. And, the top of this cycle was like 46 cents. And if you wanted to say essentially that we had an altcoin season, usually there's the first pump of Bitcoin, and then there's an altcoin season, and then there's the second pump of Bitcoin, and then the altcoin season. So we had the first one presumably going up to like the $10,000 mark almost, or something along those lines, hitting a new all-time high. Bitcoin's currently, over the previous all-time high price of like 70,000. And you would expect altcoins at this time in the cycle to already be at, for Dogecoin at this point to be above 60 cents at least. If you were to say that the cycles were similar to previous cycles, I'm not seeing it personally. So I tend to be a skeptic in this one personally. But this does go on to say the crypto market started the weekend with strong bullish momentum driven by renewed investor confidence. Bitcoin surged to $104,000, just 4% below its all-time high after President Donald Trump announced positive developments in U.S.-China trade talks. The rally extended beyond Bitcoin, with Ethereum posting one of its best daily performances in weeks. Of course, it's at 2,600, and I believe if we go over here, this shouldn't be hard to find, and we go to all... we would need to be above 4,600 approximately to meet 2021 cycle, and we hit maybe just 4,000. So still not new all-time highs. You should technically be at an all-time high for Ethereum. Not happening, right? So it's just example after example of like altcoins just not quite hitting, all-time highs compared to previous cycles. The rally extended beyond Bitcoin, like it says, and then it goes on to say, quote, crypto rallied on a wave of global optimism, end quote. Hank of Kronos Research told Cointelegraph. Ceasefire talks between India and Pakistan eased regional tensions, while news on U.S.-China trade tariffs signaled renewed cooperation between major economies. I don't know if that impacts the altcoin market. Like I said, I really honestly think it has more to do with the, essentially with Solana, right? And Solana, for example, right, we were at in 2021, 236, and Solana at its peak, this last time hit, above 250. So Solana is outperforming other alternative cryptocurrencies. And then if you look at like the trading ecosystem and liquidity over within Solana, it's pretty clear that that's where a lot of the retail money is headed. And so I think we're talking about like, I think we're really talking less about, how do I put this? Less about the altcoin season and more about really honestly meme token season. Right. And at the end of the day, that's really what we're discussing when we're talking about, will we see another altcoin season? I think will we see an altcoin season? My answer would be yes, but it's going to be in layer 2 DeFi, not in the traditional affect all other altcoins like Dogecoin or whatever it may be, right? I think that's kind of what we're looking at. And from the mining perspective, it really is going to come down to, I think, flexibility, right? So in the mining equipment itself, flexibility within that, being able to mine multiple projects, being able to shift on a dime, merge mining, obviously a big deal, all these types of things, because there is no way to tell which way the wind is going to blow outside of just knowing that a majority of the liquidity will go into essentially your tokens, right? And to say that we have an altcoin season, I think you would have to say most altcoins are above previous all-time highs. And if that's not the case, then I don't know that you can quantify it as an altcoin season. You can say, yeah, we're up 40%, but we're coming up 40% from a 90% downturn over the past year, right? And so it's like, it's not really I don't think that would be an altcoin season, at least from my definition. I don't think that would be at all, right? There's another interesting thing that's happening. Now, if you guys aren't aware, another thing that impacted Ethereum overall, obviously, was staking. There's something really weird going on. But to give you guys an idea, Ethereum started out as a proof of work cryptocurrency, and then they moved into validators and nodes. And obviously, a part of that was moving to something called proof of stake, which means there's no actual power being utilized to generate the new cryptocurrency, or very little power. So yes, it's more efficient, but this means obviously, because energy cost is everything, and then there's no cost tied to the generation of new currency, you thereby obviously depreciate the value of said currency, because obviously if you get something for nothing, then like, what's it worth, right? I mean, that's why people tout, power laws. They talk about, Bitcoin is energy, these types of things, why Bitcoin's so impactful. There is something weird happening though. So there's apparently a $2 billion Bitcoin staking protocol called Solve. And it is going to be Sharia compliant, and it will be offered in the Middle East. So this is a Bitcoin staking protocol called Solve, which has over 2 billion worth of Bitcoin locked on its platform. And it was announced Tuesday, the launch of the Sharia compliant yield product called solvebtc.core. Now, there has always been like this idea that, and this isn't directly utilizing staking to solve blocks to process transactions as you would think in a traditional staking form, but this is, you give a third party your Bitcoin, which is ill-advised in general, not to mention it's Sharia compliant, so I don't know exactly what other issues there are with that in particular, but you don't hold your Bitcoin at that point. Obviously, another third party holds your Bitcoin, and the idea is you give them a bunch of Bitcoin, and then they generate revenue off of that, either by trading or just by the price of Bitcoin going up, or utilizing it for loans and lending. In this particular case, I think lending is definitely part of it. It says it includes lending, restaking, liquid staking, and decentralized exchanges. So they could be converting it to something like Ethereum and using liquidity pools over there, or utilizing, it for liquidity pools in cross-chain type, what do you call it? Why did I just draw a blank on that? Bridging, right? So bridging, going from one chain to another, like from Bitcoin to Ethereum, decentralized forms of that. There's all that can be utilized with that to generate additional revenue. In this particular case, you would give them the money, they do the work for those particular things, and then you get it, but it's not solving any reward or solving any blocks or doing anything along those lines. The question is like, how close to the white paper of Bitcoin is this? And obviously it defies the law of like not being involved with third parties right off the bat. So I think it may be Sharia compliant, but it's not Bitcoin white paper compliant, right? Is the way I would put it. Created with guidance from Nawa Finance and accredited by Emini Advisors for Sharia compliance, Solve BTC.core generates yield by securing the core blockchain network and engaging in on-chain DeFi activities while adhering to Islamic finance principles. Solve protocol enables Bitcoin holders to lend, stake, earn yields, and invest, unlocking the full potential of their coin stash. The launch of the Sharia-compliant Solve BTC.core means Bitcoin holders from the Middle East can now directly participate in the core blockchain's expanding ecosystem to generate additional yield on top of their spot holdings. Anytime this stuff has been utilized too, by the way, it's ended in disaster. I mean, we could go back to BlockX, right? Or not BlockX, that's the cryptocurrency. What is it? I don't know. There's a few different ones. Celsius. Now, none of those are Sharia compliant, but just because it's Sharia compliant doesn't mean that it doesn't end in the same way that any infidel version of this staking would end, right? Or has ended. So just so if somebody's looking at this and being like, well, because it's Sharia compliant, is this a safer version or not? I think the answer would be no, right? At the end of the day. Now, it does say by aligning with both regional and regulations and global finance standards, it paves the way for sovereign wealth funds and traditional financial institutions to securely and confidently stake Bitcoin and earn real on-chain yields. This is a significant step in accelerating the institutional adoption of digital assets in the region, Chow said in a press release shared with CoinDesk. Shakir Hashim, core contributor at Nawa Finance, said that Bitcoin is the most widely held asset in markets like Saudi Arabia, the UAE, Pakistan, Nigeria, Indonesia, and Malaysia. And the next thing holders are looking for is the generating of additional yield. Obviously, this has been a ploy since the beginning of cryptocurrency, which is I have Bitcoin. Can I get additional yield? Then there's companies that come along like Celsius. They're like, hey, give us your Bitcoin, we'll generate additional yield. And then you end up with a Sam Bankman-Fried situation, and all of that Bitcoin kind of disappears, and you're left with nothing, at least for quite some time, until the price of Bitcoin goes through the floor and the courts somehow figure out how to get you back a portion of it, and bada bing, bada boom. It's not great. I think, at the end of the day, my understanding, like it says here, Saudi Arabia, the UAE, Pakistan, Nigeria, Indonesia, Malaysia, strong Bitcoin holdings. My personal opinion, if that's within your religious viewpoint with Sharia law and you can hold your Bitcoin and be autonomous and have that individual sovereignty and control over your finances, then that's the best way to do it. It is like, oh, well, I might miss, 6 to 12% annually of additional revenue. Sure. But if you do it and then it fails, and the thing is, like, the reason I'm so hard on these types of things, whether it be Pi, whether it be staking and yield farming, all of this type of thing, unless it's in a decentralized manner, and even then, decentralized manners, you got to be careful because there's things like LiquidX, etc. But the reason I'm so adverse to these is just because I've seen it happen in the past over and over again. Bunch of people put their money in, the initial rewards look good, and then they influence a bunch of other people to put their money in, then the crypto market crashes, and then the company or project or whatever it is goes insolvent, everybody loses their money and nobody gets it back, and that's pretty much rinse and repeat every single cycle, right? It's not rocket science to look at it and say, hey, this is everything that's happening, right? So that's kind of what I think overall. I did want to say, somebody said, guess I'm buying a few meme coins now. I did want to say, stay away from meme coins. I think the easiest thing, so if you wanted to look at, okay, they're like, here's the fact of the matter. If you want solid gains that are going to be impacted by the halving cycle right now during this cycle, it's going to be Bitcoin and it's going to be Solana. And the safest thing is not putting your money into Solana and then buying meme tokens. It's literally just putting it into Solana. if that makes sense. And that's historically proven, right, over the past few months, because Solana has hit an all-time high, which means that in theory, so let's do this. Let's look at this, right? I think this will be a good practice if we want to talk about this. We'll go back to this here real quick. So if you looked at like Bitcoin all data, right? And then we had that 63,000, but this previous little spike up, right, to 107,000. We can be reasonably sure that between now and October, that Bitcoin will hit 107,000 again, right? So we'll do a percent calculator. This will be the easiest way to do this, right? So what is 103, or what is, this is what percent increase from 103 to 107, right? Let's just say rough numbers. You'll have about a 4% gain in Bitcoin from where it's at right now. But if we looked at Solana, which has hit an all-time high again before, and so we can be reasonably certain that we're going to hit around $250 from 175, right? So we say 175 to 250, and we calculate that out, we could reasonably assert that the altcoin season in Solana will net you, if you purchase Solana right now today, would net you a 42% gain. So does that make sense? Obviously, I'm not a financial advisor. This is just off of what's happened over the past few months, what's gaining traction, what has the highest upside. And the highest upsides or the highest upside, frankly, right now, just because of use, all of that, that has performed this cycle is Solana, right? That's one that we could say I'm reasonably certain that Solana will perform, right? The harder ones, right? Like the new cycle coins, let's take like a Kaspa. Kaspa's on the up right now, right? So, but if we go to all, I think the hard part with Kaspa is when it hit. So let's look at Bitcoin again. It was like December. Yeah, it was December. So in December, right around here, Kaspa was at its 16 cents with its high being at 20 cents. And then if you fluctuate into an altcoin market, which would have been around here, right? It was at like 13 cents, 12 cents, something. So Kaspa is a weird one, right? Because it's a new cycle cryptocurrency. It wasn't around previous cycles. So we don't know what it would have been valued at in 2021, for example, right? So it makes it a little confusing. But we don't have what I would say guarantees in this particular scenario, right? We can't say, because the altcoin, like, what was it? Let's go back. Hold on. Let me go back to this real quick. Let's get the number off of Solana again. This was in, let's say January. So if we go January, which would have been right here. Yeah, so it's that 12, 13 cents mark, that 13 cents mark, right? So we would have expected to see Kaspa's all-time high in January over the 20 cents, but it's not, right? It's at the 13, 14 cents. So that means that we don't have a reasonable assertion to say that Kaspa would go back up to its all-time high again, based off of this cycle's performance. And so like when you ask me those questions, and you will not have that with any of the tokens either. So it's not the moral of the story is not buy tokens. The moral of the story is buy the token of the layer one chain of which most liquidity is going into, right? This is why Ethereum was really good last cycle, right? And the fact is just Solana is eating Ethereum's lunch all day long. It's not even a question, right? So let's get into more of the fun stuff, mining news. Here's a weird one coming from Aslan, OX_Aslan, referencing both Vertcoin and DigiByte coin. Both of these cryptocurrencies have been around for a very long time. I believe Vertcoin's definitely like a 2017 coin, 2016 coin. DigiByte's like a 2014 coin. Just a little bit of history on DigiByte. DigiByte was around at a time when ASIC resistance was just approached differently. So back in the day, before, Bitcoin ASICs were really on the rise, or right as Bitcoin ASICs were on the rise, there were a lot of people discussing, how to prevent ASICs from getting onto the network. And DigiByte was, I think a little bit before Ethereum, but was kind of pushing towards that. And the way they decided to approach it, and was actually the way that Ravencoin adopted too, but in a different manner. But the way that it was originally approached was, we will have multiple algorithms. So what DigiByte did was they had 5 algorithms that you could essentially mine, including SHA-256 still, but it evened it out, right? So basically, yes, ASICs were allowed on the network by nature of being able to mine with SHA-256 or script or whatever it may be, but they were weighted algorithms. So they would weight the 5 algorithms against each other. So you would have your Skeen and a few others. Let's see. So I have the history pulled up here so we can get the actual 5 for you guys. So SHA-256, script, Qubic, Myriad, and then Skyn or Skeen, however you want to pronounce it. I forget at this point. So you had these 5 algorithms, and they were weighted for their ability to find a block, meaning that if you had were utilizing an algorithm that was primarily GPU, you could still compete with the ASIC miners that were on the SHA-256 side of things. And this meant obviously better decentralization because multiple forms of hardware could mine on it. So it wasn't ASIC resistant, but it was essentially 51% attack proof by nature of weighting these algorithms against each other and allowing multiple forms of hardware to mine the cryptocurrency. And this is all important because this has to do directly with the algorithm. Now, eventually what happened is that we had Ethereum come out, and Ethereum's approach to mining was to go completely ASIC resistant. And the way this was done on Ethereum is that we saw essentially something that was called like memory hardening, or basically utilizing the memory on the GPU in particular and filling it up so that if you went to go build an application-specific integrated circuit for that algorithm, you would still have the cost of adding all the memory modules per ASIC unit. So to give you guys an idea, that means that you increase the cost significantly to build an ASIC, because now you have to have additional PCB space, you have to have the memory modules, and you have to lay that out per ASIC chip for that algorithm. Now, eventually, as we know, ETH ASICs did come along, but GPUs were sort of competitive, but that was the way that they took. And then, just to give you guys like a full history, you had something called Ravencoin that came out with X16 VR. And X16 was essentially 16 different algorithms that were rotated within the same algorithm. So within the same mining process. So as opposed to having multiple algorithms, right, that were weighted and you mine just that one algorithm and then you're paid out based off that, this one would rotate the algorithms. So you couldn't build an ASIC for any one specific algorithm because it might mine it for a minute, and then based off of the final hash, it would take a certain portion of that, and that would determine randomly the next algorithm that it would switch to, and that made it impossible for the prediction to happen for the ASICs to say, oh, kick over this, kick over that, kick over this. And that is how ASIC resistance worked early on with Ravencoin. And then eventually what ended up coming out was like ProgPal, with Ogata Girl and a few others, the LOL miner dev. All those guys worked on that. A lot of different people did. And that was essentially getting to the point of utilizing the entire GPU to mine. There is like specific instruction sets that prevent the ASICs, but to make it as simple as possible, utilizing as much of the GPU as possible so that you would have to mimic an entire GPU to mine. I think that's the best way I can explain ProgPal without getting into the specific reasoning for like each instruction set, which I have covered in detail on the channel before. So if you're interested in that, of course, look those videos up. So all of that to say, we also at one point had Vertcoin, which was VertHash, and VertHash was a low power ASIC resistant mining algorithm. It still has no ASICs on it. Potentially there's an argument that ASICs could be put on it, of course, but you would have to have the financial incentive for that to happen, which of course right now there is not one. I'd have to look into it more as to how viable that would be if Vertcoin took off. But as it sits right now, it's a low power ASIC resistant mining algorithm, really advertised as being able to mine while game. And that is the big thing behind it, is you could run the VertHash cryptocurrency miner on your gaming PC and still play video games without a massive performance impact on your video game. Of course, this is the way it does this is through, once again, loading up the memory. The problem is now, of course, this is less and less viable, at least in my recent testing with VertHash, due to the fact that we have 4K textures and a lot of effects and stuff happening on the GPU that are loading up the VRAM. And to compound that issue, modern GPUs are not getting the subsequent increase in memory capacity on a generational level that they have in the past. And so you're ending up with more performance impact, or at least having to turn more visuals down to maintain the performance in the game while mining VertHash. So I don't know that their selling point is as viable as it has been in the past, except for the big thing, which is that the DAG is at 1.9 gigabytes, meaning you can still mine on 2 gigabyte GPUs. But like, let's say you have an 8 gigabyte GPU trying to play a modern game, you're going to frequently utilize more than that. Thereby, of course, if you are trying to mine VertHash, you will be impacting, of course, your performance in that game. So the primary arguments against this particular thing, so let's go over what the proposal is. That's a whole history lesson in ASIC resistance. That's a history lesson on mining, why these decisions were made, how these algorithms work to maintain that. And the reason you need to know that is because this proposal directly, obviously, is related to it. So the proposal is to add Vertcoin's VertHash to the DigiByte coin multi-algo framework. And that would enable merge mining with Vertcoin. Now, the question that comes up, and what I understand, is that VertHash would be in the multi-algo. The question that comes up is, are the other 5 algorithms going to be, also mineable with Vertcoin? I don't have an answer on that. The other question that people have is people are worried that adding a sixth algo will negatively impact DigiByte, which I don't have the answer on that as well as of right now. I've tried to read through the DIP. I get a 404 on that. I'm going through some more, but they're saying that this would strengthen the network security and reward GPU miners and unite two strong proof of work communities. The arguments against, like I said, unfortunately, like this guy just says no, he doesn't give a lot of information on it. Retro Mike was another opinion that I saw that I'm referencing adding the sixth algorithm to. And then essentially, I think, well, here's the thing. I think for DigiByte right now, the other algorithms that they have are, I think adding vert hash to DigiByte multi-algo framework and allowing people to mine it isn't a negative thing. Now, except from the perspective that the current reward structure would be adjusted, right? So a lot of people have problems within the cryptocurrency space when you're adjusting the reward structure, right? So if you add another algo in and then you allow people to mine also DigiByte with that, then that in theory reduces the reward incentive for all the other people mining the 5 other algorithms, right? And so that's really where the question comes into play as to how that would be handled. And like I said, the actual proposal, I haven't been able to find exactly. But this is a really interesting move forward. Obviously, I think only 58 likes, not a lot of people talking about this right now. But I think understanding the relevance of DigiByte. DigiByte was also extremely popular in like Venezuela, where they dealt with a lot of inflation at the time. It was used pretty heavily. DigiByte's been around for a long time. VertHash has been around for a long time. So I'm not opposed to this, but I am aware of people that are opposed to it for, you know, obviously the said reasonings. So I think there's got to be a little bit more information on it. Hopefully somebody will reply here and then we'll go from there. Now, Crackling says, remove an ASIC algo and the problem solved. You know, I think that would piss... I mean, you want to talk about problems of all these little lotto miners. I think DigiByte is getting a lot of security from lotto miners right now. And that is because people that were purchasing a lot of lotto miners were realizing that they were just wasting their money, and they decided to start solo mining or mining DigiByte because you could generate essentially revenue off of these little lotto miners on DigiByte. And that's kind of the trend that's been going on right now. I am for kicking them off. I think the lotto miners teach poor cash flow habits. I do think like it's an interesting proposal to mine, you know, DigiByte or you know, some other SHA-256 available algorithm in project. But I would agree with you. I mean, just kick. I think kicking SHA-256 off makes more sense than kicking Script off. If I was going to theorize on that, just because Script, I think at this point you can merge mine. DigiByte is the primary, right? If I recall, on Script, and then merge mine the other ones underneath it, and it's a more versatile algorithm. So it's more along the lines of, you know, less centralized shovel sellers at the end of the day, right? Yeah, Mick, everybody thinks that the token that they own a lot of is badass. I mean, well, just gotta say it, dude. Just gotta say it. All right, so Ethereum just went through its Petra upgrade and had $13 million worth of ETF inflows. So a lot going on with Ethereum right now. I think the biggest thing is the Petra upgrade. It did introduce 11 key improvements designed to enhance the network speed, cost efficiency, and scalability. This is obviously needed with, basically Solana eating their lunch at this time. It does say that the most notable change is the increase in the staking cap from 32 ETH to 2,048 ETH per validator. And if you wanted to talk about just throwing decentralization out the window, I mean, this is it, right? Now, the argument is that it's going to attract institutional stakeholders. Well, obviously, because you're going to have a massive institutional company to invest to run a validator, because that's insanely expensive. With the cost of Ethereum, let's go ahead and look at this, right? Let's go back and go, and Ethereum's 2,600 right now. So 2,600 times 32 was already pretty iffy, over the average salary of a United States citizen to run an Ethereum validator node, which is already dumb as shit. And then they're going to add this on to where it's going to be 2,048. So we'll do 2,048 times 2,600 to run a validator node. You'll need $5.5 million fucking dollars to be a validator on Ethereum. And yes, the F word is definitely necessary here. That's clearly, it's not that it's going to attract institutional investors. It's that institutional investors will be the only one able to do this. I mean, outside of, the outliers like an Elon Musk or something like that being able to have a validator. And this coming from the cryptocurrency that started off with ASIC resistance for decentralization is just baffling. And so, yeah, at the end of the day, when I see Ethereum not hitting its previous all-time highs, I'm like, good. I hope Solana completely destroys it, because at least if I'm going to have, a centralized cryptocurrency chain that's running a majority of the liquidity in the market, at least, they started out that way. It's a complete betrayal of everything that Ethereum claimed it stood for in the beginning. It just is. It's crazy. So the reasoning for this is, or combined with that, they're going to secure more than $60 billion in total value locked, and it signals growing stability and maturity for the network. However, Ethereum still trades roughly 37% below its 2021 peak, with some investors cautious due to increasing competition from newer, faster blockchain networks. Everything's faster. I think we did talk about the layer 2 solution for Ethereum called Mega ETH, make Ethereum great again. They'll be extremely centralized, but will be faster than everything else. But even proof of work networks are faster than Ethereum now, right? Caspa's faster, Qubic's faster, Zealous is faster. There's a lot, at the end of the day. And the problem hasn't been speed as of late. The problem has been empty blocks, meaning no transactions in the blocks, and that's true for Bitcoin too, at the end of the day. So it's really coming down to use case, and there's not been a use case, especially in a depressed market, that people really want to get into. Because the fact of the matter is that retail investors get into cryptocurrency to make money. And if retail investors are broke, they're not going to have additional extra income to put into the market to make money. And therefore, they won't do it, and then they're not being utilized. So until there's a use case, obviously the reason Monero is probably doing pretty well this cycle, a use case of, privacy at the end of the day. right? Unless there's a use case that, you know, normies are legally comfortable with, I just don't see a ton of liquidity going into the cryptocurrency market at the rate that it did previously. And because of that, you will, like I said, you're just going to see like a couple. Like I think the altcoin market is basically Solana and nothing else. And then you have your Bitcoin, right? That's seems to be what's happening outside of like, you know, some outliers here and there. Obviously, these new cryptocurrencies are still finding their starting point, right? Whether that be KY, Zealous, Caspa. Like we can't determine market performance based off of the, you know, cycle from currencies that don't have historical relevance to it, right? And that's pretty much my argument as far as that goes, you know. So it does say, you know, as the crypto market continues to mature, brokers who stay ahead of these developments will be better equipped to guide clients through the evolving landscape of digital assets, offering smart, risk-aware pathways into Ethereum-backed instruments and beyond. I think Ethereum is just going, you know, the problem at the end of the day is that Ethereum's been going against its own ethos consistently for an extremely long time at this point. And because of that, like I don't see it actually competing at the level that it really should be competing at with other blockchains, because it's also falling behind on a technical perspective, from a technical perspective, right? It's slower, the fees are high. And now, like you're talking about, here's the thing that made the participation on ETH, which brought the liquidity. Okay. Participation is everything in cryptocurrency at the end of the day. Increasing your well, first of all, moving the proof of stake for Ethereum reduced the amount of participants significantly. Okay. Then now you're increasing the staking cap from 32 to 2048, right? Thereby additionally reducing the amount of participants at the validator level, right? Which thereby reduces the amount of people that will participate within the network. Now you could say, well, it's just increasing the staking cap. You can still stake at 32, I think is the case in this particular one. I wanted to go back and clarify that. But the fact of the matter is that a 32, if that is the case, right, which I still need to go validate. But the fact is a 32 ETH validator will not make as much as a 2048 ETH validator. And you just aren't going to be able to compete, right, at the end of the day. It's crazy. Yeah, Bitcoin participation is extremely low too. Yeah, the participation's extremely low. I mean, everywhere but Solana. Right? So there's another weird thing happening. Monero mining on Qubic is now live. I'm not exactly sure what's going on. I saw the video from Rabid Mining. We're going to watch the video. I'll share it, you know, obviously hit the like, do all those sorts of things. Okay. So this is what I read, which was the Qubic dev team together with node operators has developed a powerful new framework that allows miners to perform Monero mining while securing the Qubic network. So this is apparently coined useful proof of work. And the same mining power securing Qubic can now also generate economic value without compromising network security. Because of the uniqueness and complexity, this feature has been long under development, and for at least 1 week, it is still under testing. This custom mining framework highlights Qubic's implementation of useful proof of work by assigning meaningful work to miners. be it AI training, Monero mining, or enterprise compute. So what this sounds like to me, and you guys correct me if I'm wrong, because I already, like, obviously Qubic doesn't seem like it's actually mining, and I'm, you know, but let's set that aside. Are you guys familiar with Salad? I think Salad's the best example here. So Salad, you download, obviously it's centralized, you get paid out in PayPal, blah, blah, blah. You set your computer to work on it, and then it goes and finds work. One of the things that you can do on Salad, right, is that if it's not running an AI model, it'll go mine some form of cryptocurrency. That will go to the developer of Salad's wallet, you know, their cryptocurrency wallet. You get paid out in US dollars, right? To me, this sounds essentially like that with a disguise of mining Qubic, which then also brings into question of what is actually which we've always had this question, like, what is actually happening when you mine Qubic? So useful proof of work, which has been coined, I think, even before that by like Dynex, all that sort of stuff, right? Dynex has proof of work. Dynex, to be fair, has a proof of work portion, and then the useful proof of work portion with the models. I think this is similar to that. But it effectively just means that you're, you know, renting out your hardware, and in return, I guess you're earning Qubic. There was some question about, I guess you can earn Monero, and then there's some burn mechanisms going on. So let's go ahead and listen to Rabbits. But that's what I read. Seemed like that's what my initial thoughts were when I read it, right? Which was like, oh, this is just, you know, Salad with a cryptocurrency skin over it, right? Yeah, help me. Well, and so their hardware, here's the thing, here's the other thing that makes me think all of this, is that traditionally when you're changing the hardware requirements, there's some sort of change in the software that you are running, right? Which means that I think the requirement changes for Qubic are directly related to the type of work it's doing, which means it is more along the lines of like I said, like a Salad with the face of cryptocurrency over it, right? Oh, there's no audio for you guys? Okay, let's fix that real quick. I think I know what it is. Here, we'll restart it. Here we go. Let's take a look at it. We'll have them clip that out. You should be able to hear it now.
What's going on, everyone? Welcome, Rabbit here, and Qubic has enabled XMR mining live on their network. Now, what does this mean? That's kind of what we're going to go through.
It needs to dust his router
right now and help you understand
or is that just a switch?
What is
Probably
going on with Qubic and their XMR mining. As most of us are well aware, they constantly change the algorithm, constantly changing the hardware and requirements needed to even mine Qubic. But over the past 3 months...
So that's what I was responding to earlier, which was like, change in specifications means change in software requirements, right? Which means like that's probably directly related to what they dub useful proof of work, right? Which as I've seen useful proof of work as of right now, there's no algorithm in which the useful work is done within the algorithm itself, right? So the way it works, so we talked about vert hash, right? And part of the thing is like, well, you can game while you mine, right? And so in the case of like Dynex, for example, you have the portion that's doing the proof of work, and then the other portion, which is a model that you're solving. So I presume Qubic is assigning that model, and then there's software requirements for those models in particular that are forcing them to make these requirement changes for the mining itself.
So it has been locked while they try to finalize and update some of their protocols, I guess. I don't really know what's going on in that aspect, but bottom line is it has been dominated by GPUs over the past 3 months with no sight of CPUs getting any better. So why did they enable XMR mining, as XMR is dominated by CPUs and GPUs are absolutely horrible when it comes to XMR? So what's going on here is CPUs are mining XMR in the idle time on Qubic. And guess what? Here's the kicker. You are not getting paid for it. So all the XMR that is being mined on your CPU mining farms is going to the dev come from beyond. I don't know if it's multiple.
So it's literally salad.
Wallet setup or not, but as far as I'm aware, it's going to the Qubic dev. And what he is doing is he is then going to sell that XMR by Qubic and then burn it. Therefore, causing a deflationary while keeping the price up.
Deflationary is just price manipulation, right? So I like how all the time in cryptocurrency, we like to be like, well, they're burning it, so it's deflationary, so it's good. No, motherfucker, it's called price manipulation. I'm so tired of these terms. We're going to obfuscate essentially, ethically questionable practices with, financial terms that don't mean shit. And it's everywhere. And I get it. I'm going to continue to bleed followers and viewers on my channel as I call this stuff out, because I'm going to piss everybody off. But that is what it is. And I just I feel, and I get it. You don't you can't bite the hand that feeds blah, blah, blah. But I feed myself, bitch. I don't need it.
On Qubic through them buy orders. So in theory, it should help Qubic go up. But why do CPU miners got to take the brunt of it? Well, they do claim that they have a more unique unicorn community where they think everybody loves Qubic and they support the network, and CPU miners will have no issue donating their power for GPU side to make more money. That makes zero sense in my mind. Most of the
I haven't looked, I was mining Qubic over here on this 5080, right? But isn't the part of the requirements, I suppose, should I say, the CPU related, even if you are GPU mining? I need to look at that again.
The miners that I'm aware of and that follow the channel are obviously profit driven. They do not donate their power for the good of a project. Hash rate follows price. If profits are there, hash rate will come. They do not mine for free and not even get anything out of it. So I did ask Come From Beyond about this situation. You can see everything right here, fully transparent. So, hey, when XMR gets implemented in the next week or two, will the algo change to favor CPUs again so they can actually come to mine? It's 1 to 2 weeks migration, should be gradual to give miners time to choose pools. Main mining algo changes are frozen now until we finish custom mining. Yeah, but when you are able to change it again, will it move back to more CPU friendly to bring in CPUs to mine Monero? Don't make much sense to CPU mine the way it sits currently.
So what he says here, the Come From Beyond guy says that we don't know, depends on the Monero mining launch. What he's saying is the reward structure is purely dependent on how much the dev is making off the work your machine's doing. So it's salad. Well, I mean, that is what it is. So what he's saying is if the dev is, so if the dev with this implementation is making a lot of money off of Monero, which is driven by CPUs, then CPUs will become more profitable on Qubic by nature of the Monero mining being more profitable for the developer. So I can interpret that for you, right?
With GPUs blowing them away. That we don't know. Depends on Monero mining launch. Like, how can you not foresee things where you're dominated by a piece of hardware that cannot mine Monero, but you want to mine Monero and you don't have the hardware to support it, you know, and you're not even going to pay the people to do so in the first place. So everything is really weird going on right now. I don't really know or understand what the thinking behind.
So that's what I'm telling you what the thinking is. So hopefully, Rabbit, you watch this. What's happening is the work your system doing is profitable for the project. And depending on how profitable the work is, which in this case is the Monero mining, will determine the profitability of the type of equipment you give to the Qubic network to mine. That's how I would interpret that entire thing.
Behind it all really is. Now, with all that being said, if you are a CPU miner and you want the option to still mine other coins, there is one pool that I'm aware about that is allowing people to do so, and that is the Jetski Qubic pool. So be sure to check out this mining pool if you are a CPU miner looking to do it. This is the pool I actually do use when I do mine Qubic off and on, and I'm really enjoying it. On top of it, as one of the fastest miners out there. So check out the Jetski Qubic pool. If you want a setup guide on how to utilize it, let me know in the comments, and I'll try to get that together.
Hey, Nakudo, welcome to the stream.
Now, there are a few people out there that do have very cheap power costs, and they don't have any issues, and they do love crypto for the tech. Now, that is very, very rare, and I don't think Qubic really has that. Let me know in the comments what you think about everything I have said so far, because I really want to know.
I don't think that it's Qubic doesn't have the community with cheap power that cares about the cryptocurrency itself. I think that the value, I think that Qubic, from a technical perspective, isn't clear on what they're doing and transparent. And I think that is why they don't have that audience, right? Whereas, if you take a look at something like Ravencoin, which is completely open source, is very transparent, blah, 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 you will have the people on Ravencoin that have been mining at a loss since the day it came out, right?
You plan on donating your power costs for the good of GPUs out of your CPUs to make nothing. So that's pretty much what's going on currently with Qubic.
Well, you're not making nothing. You're getting the Qubic payout, right? It's just enabling that on your system to generally increase the profitability of the Qubic network for themselves. Yeah, so Agent is asking, so you're saying even though the miner is reporting it's on the CPU while mining Qubic, it's actually mining XMR. Yeah, this has been done, but there's been applications that have been caught doing this type of thing in the past, right? Like I said, the best example is Salad, right? You don't know what work, Salad will tell you what work it's doing, but you don't know 24/7 because you're not around your computer all the time. You're just getting paid out on PayPal, and it's doing whatever it's doing for direct financial gain of the developer of Salad. And I think, like I said, what you're seeing with Qubic is effectively that, with as far as their useful proof of work portion goes, right? Their solver portion, that mining portion with the solving, that's a lot closer from a technical perspective to TON mining, right? Effectively. For just to give you the easiest comparisons. But the useful proof of work portion, that's what it's doing. It's just a cryptocurrency mask for Salad. or Vast AI, or, you know, pick your project. I just use Salad because Salad has the cryptocurrency mining integration into it as well. And the reason you integrate the cryptocurrency portion into it is for 24/7 revenue generation, right? So let's say you're running what is effectively an AI compute company as Qubic for the useful proof of work side of things. And you need to generate income. Well, whenever there's no models for the useful proof of work, that dev isn't getting paid. So what he is doing is saying, okay, well, what I can do is add on this Monero mining. That will be part of the useful work, and that will supplement, because the goal is essentially to have other people's equipment working 100% of the time on the useful proof of work side of things for you. That's the goal. It's 100% uptime, essentially, just like it would be in any other technological industry. But that uptime means you have to have that work. Well, you're not going to have AI workloads 100% of the time. So you need to figure out what to do with that other time. And what they're doing for that other time is XMR mining. Anyways, that's what's going on. I think I got a better handle on it. Thanks, Rabbit, for a little bit of the catch up, and then that helped me understanding. Make sure you guys go like the video. If you're not subbed, I'm sure you're subbed to Rabbit at this point, but if you're not, sub to him. There's the pool as far as that goes. I did want to mention, and I haven't looked into this, let me know if you guys want a how-to, but you can mine the other token, which is the key token, or the Chi token, excuse me, QI, on the KY blockchain, which is the other token. Currently, my understanding, it is only available on alphapool.tech. I will link this to you guys as well. But I wanted to give him a shout out and let you guys know there is another option there. The curious part about this, of course, is we don't have mining calculators for it. There's only 10 active miners on this particular pool. So I have no idea what the profitability in particular looks like for this, but it could be potentially, you know, at least decent. You will have that liquidity option between KY and Chi already. So there's that potential. But I don't think there's a directly related price to Chi right now. I think it's only KY, right? And then there's the, because I don't think Chi will come up at all, right? No. I'll look into it more and let you guys know. But there you go. A couple of hardware updates. I was correct. So everybody on X that was telling me, no, the ASRock motherboards are fine and blah, blah, blah. Oh, look. ASRock motherboards show fluctuating SoC voltage reaching 1.27 volts, and that is a risk factor for the Ryzen 9000 CPUs. You need to be careful with this if you're running a 9000 series CPU on an ASRock motherboard. And this comes from Brian. He's been one of my early mentors on YouTube, by the way, from Tech Yes City. He's a great guy. I definitely recommend his channel. And he says that he tested these on a few motherboards, revealing a difference in how ASRock motherboards supply SoC voltage in contrast to others. If you are aware of the reports of dead Ryzen 9000 CPUs, particularly the 9800X3D, nothing conclusive has been found regarding the issues that are causing these deaths. Perhaps this is one of the first investigations that shed some light on the issue and might help users understand what is actually causing the CPU deaths. And it isn't the first time that we've seen a 9000 CPU dying on an ASRock motherboard, but there are actually nearly 200 such reports, most of them on Reddit. He finally tried to figure out what was going on, and as you can see in CPU-Z, you can see it peaking to 1.265 volts. Even though the fluctuation isn't that significant, the upper limit is somewhat higher than what is considered the maximum limit. So we can see that the SOC voltage in both cases exceeds 1.25 and comes close to 1.27. This is higher than what motherboards from the other vendors could supply to the SoC of the CPU and remains mostly near 1.2 volts, except for the Asus X870E Crosshair Hero, which has by default added another 50 millivolts. Nonetheless, it doesn't budge and remains constant all the time, while the ASRock motherboard keeps fluctuating, which may result in permanent CPU damage, as we've seen before. Nonetheless, it should be kept in mind that it is the CPU that dictates how much SoC voltage is needed, and the deaths appear to be the result of how both CPU and motherboard handle the SoC request. Surely this needs to be deeper dived, etc. But if you're running an ASRock motherboard with a 9000 CPU or thinking about upgrading to a 9000 CPU, maybe at least hold off until there's a BIOS patch. There have been a couple BIOS patches. They haven't directly said that it's related to this SoC voltage, just voltage in general, because I have seen it on a couple of my ASRock AM5 motherboards. I did swap to a GigaByte motherboard for my main rig on AMD just because I don't want to deal with it. But there is that, so keep that in mind. And then I saw this for the miners and everybody. This might be interesting. AMD did unveil the EPYC 4005 series processors. These processors are essentially AM5 socket EPYC processors. So server grade processors for the AM5 platform, which I found really, really interesting. They're designed to run 24/7, obviously good for CPU mining. And they do have the 16 core 32 thread at the top in the EPYC 4565P. And this is going to also, which is really interesting, be available in bare metal and cloud compute instances in Vulture, which I utilize. I think there's some affiliate links running around there in Vulture. So maybe I can go test some out for mining over there on Vulture. I think they still allow it over there, so we'll see how it goes. But there are 1, 2, 3, 4, 5, 6 different models, with the top range being $699, and that will be an X model, which will get you up to the 5.7 gigahertz boost with a 4.3 gigahertz base. And that will be 16 cores and 32 threads. They go all the way down to a 6-core, 12-thread option of the 4245P, and that will be a base of 3.9 gigahertz and a boost of 5.4 gigahertz. I think, for longevity in mining, these are quite interesting because you can slot these into AM5 boards. They will work with non-ECC memory, presumably, which reduces your memory cost, but are still designed to be running, server level workloads for a very long amount of time at peak efficiency with lower latency. Obviously developed for IT administrators, but could be extremely useful for cryptocurrency mining, or really even in any sort of AI build you may be looking at in the future. I think obviously the lanes are better than the Intel competitor on AM5, but lanes are more limited than obviously their full line of EPYC series processors on the server grade side of things. So keep that in mind if you're wanting to run X amount of GPUs and blah, blah, blah. Make sure you look up the specific specifications for the new EPYC series AM5s. But I'm pretty excited about those. I think those are pretty cool. As far as GPU mining, everything's looking a little bit better with KY and Qubic coming on to the profitability. Just figured I would mention that. And I was going to do a coin review of Adventure Coin, but we are 20 minutes past Doom being available to play, and I really want to go play that. So we'll cover this in another one. Next week, we'll cover this Adventure Coin review. And Hawk, thanks for stopping by. Make sure you guys go follow Hawk over on YouTube and Twitch. I'm going to hop over to Twitch here in just a second only, and we'll be checking out the new Doom Dark Ages game. I have it pre-installed over here on my gaming PC with a high refresh rate monitor, so we're going to see how it plays and hopefully have a lot of fun with that. So there you go. Thanks everybody for watching today, and I will see you next Tuesday.